The year 2025 will be remembered as the moment when artificial intelligence transformed from a promising technology into an unstoppable financial juggernaut that shattered every conceivable record in venture capital history, creating a feeding frenzy so intense that seasoned Silicon Valley investors openly questioned whether they were witnessing the birth of a transformative new economy or the inflation of the most spectacular bubble since the dot-com crash of 2000. The numbers tell a story that seems almost fictional in its audacity. America's largest private companies raised an unprecedented $150 billion in 2025 alone, absolutely demolishing the previous record of $92 billion set during the pandemic-fueled investment boom of 2021, with the overwhelming majority of that capital flowing into artificial intelligence companies and deals that closed with shocking speed, minimal due diligence, and valuations that would have been laughed out of boardrooms just 3 years ago. According to exhaustive tracking by TechCrunch using data from Crunchbase and PitchBook, an astounding 55 American AI startups achieved unicorn status, meaning they reached valuations exceeding $lost billion throughout 2025, with some companies raising multiple mega rounds worth $100 million or more in the same calendar year, a phenomenon that occurred 8 times compared to just 3 instances in 2024, suggesting an acceleration in both investor appetite and startup burn rates that defies historical patterns. The sheer concentration of capital flowing to the industry's giants proved even more remarkable. The top 4 deals of 2025 accounted for more than 30% of the total deal value, with OpenAI's record-shattering $40 billion raise at a $300 billion valuation representing the largest private funding round in human history, followed by Anthropic's $13 billion across 2 separate rounds that pushed its valuation to $18.3 billion despite CEO Dario Amodei's leaked memo admitting he was not thrilled about taking money from dictatorial Gulf states. Elon Musk's ex-Madian dollars whispers of a $20 billion Series E announced in early 2026, and Meta's nearly $15 billion acquisition of data labeling powerhouse Scale I2 lock up CEO Alexander Wang and his team. This unprecedented capital concentration prompted Kyle Stanford, a PitchBook analyst covering venture capital, to issue a stark warning that sent ripples through the investment community. Market value concentration indicates an increase in long-term systemic risk to venture capital, as that value has proven difficult to realize even while private market values keep growing and revenue multiples reach unsustainable levels. He wrote in a widely circulated report that dared to question the sustainability of valuations that assume AI companies will capture economic value orders of magnitude beyond any technology in history. The feeding frenzy extended far beyond the household names, with 55 distinct American startups crossing the billion-dollar threshold throughout the year, in a diverse array of AI applications that ranged from the obvious language models, image generators, video creation tools, medical scribes, customer service agents to the unexpected, including OSHI's $1.2 billion valuation for vertical farming with AI optimization, even Aerotech's hydrogen-powered drones, and even non-A plays like prediction market Polymarket reaching $9 billion and satellite company Loft Orbital achieving unicorn status. The monthly breakdown of unicorn births reads like a venture capital fever dream. December alone saw 7 new unicorns, including unconventional $4.5 billion valuation from a $45.5 million seed round led by Andreessen Horowitz for energy-efficient AI computers, and Airbor securing a $4.3 billion valuation with a $350 million seed as a crypto bank barely months after founding. November added 9 more, including Luma's $4 billion valuation for iVideo generation and Reflection's staggering $8 billion valuation for open foundation models. October contributed another 9 unicorns. September brought 6. August delivered 7, including FieldEye's $2 billion valuation for autonomous robot operations and the gaming company Shrapnel crossing into unicorn territory. July saw 8 new billion-dollar companies. June added 6, including the medtech company Abridge reaching $53 billion and Thinking Machines shocking the industry with a $10 range from a $2 billion seed round for OpenAI. Alam Mira Murati's AI research company that hadn't shipped a single product, and the first half of the year from January through May saw the remaining unicorns emerge across healthcare, fintech, legal tech, and infrastructure plays. The speed and scale of these deals represented a fundamental shift in how venture capital operates, with Tim Tully, partner at Menlo Ventures, observing that you're seeing people raise these large rounds with no decks, which is kind of shocking, or not even absolute clarity around precisely what the company is going to do, adding that you're seeing funding of teams over what the team is doing, a return to the personality-driven investment thesis that characterized the most frothy periods of previous tech bubbles. The transformation proved so complete that more than half of all venture capital dollars and 36% of total deals now flow to I companies, according to Silicon Valley Bank, with Crunchbase reporting that 14% of all global venture investment in 2025 went to just two companies, OpenAI and Anthropic, a concentration of capital that would alarm antitrust regulators in any other context, but seems accepted as inevitable in the AI race. The infrastructure requirements driving these massive raises became clearer as big tech companies collectively projected spending more than $5,500 billion in 2026 alone to build AI infrastructure, including data centers, specialized chips, cooling systems, and power generation, with Elon Musk's AI exemplifying this capital-intensive approach by building the Colossus supercomputer, acquiring a 1 million square foot facility for expansion, and developing a 500 megawatt data center in Saudi Arabia using NVIDIA chips while simultaneously training its next-generation Grok 5 model. The human capital competition proved equally expensive, with Meta's nearly $15 billion acquisition of Scale AI representing not just a technology purchase but a talent lockup, while AI Labs engaged in bidding wars that saw senior researchers and engineers commanding compensation packages worth millions annually, sometimes tens of millions for true stars, as companies desperately competed to hire the limited pool of individuals who truly understand how to build, train, and deploy large language models and other frontier AI systems. Yet even as this historic flood of capital reshaped Silicon Valley and created paper billionaires faster than any previous technology wave, cracks began appearing in the narrative of unlimited growth and inevitable success. The second half of 2025 brought what industry insiders described as a vibe check, not a crash or even a significant pullback, but rather a subtle shift from unquestioning optimism toward more nuanced assessment of risks, sustainability, and actual business models that might justify the astronomical valuations. Several factors contributed to this mood shift. The emergence of DeepSeek, a Chinese AI lab that achieved competitive performance with OpenAI's models using a fraction of the computational resources and budget, fundamentally challenging the assumption that frontier AI required tens of billions in capital. Growing public fatigue and skepticism toward AI features being aggressively pushed into every product from therapy sessions to children's toys to dating apps, often with minimal user demand, increasing regulatory scrutiny in both the United States and Europe around AI safety, bias, copyright infringement, and potential job displacement, and most fundamentally, the dawning realization that despite hundreds of billions invested, no AI company had yet demonstrated a clear path to profitability that would justify even a fraction of their current valuations. Michael Carman, co-head of private investments at Wellington Management, attempted to address these concerns by noting that AI companies have been growing revenue at historically fast rates quicker than previous generations of software-as-a-service companies, and that widespread internet use gives new AI products essentially instant access to massive potential markets, arguing that when you think about the total addressable market of AI over the longer term, it could be the largest TAM of anything that we've ever seen in technology. This optimistic view found support from those who drew parallels to previous transformative technology waves, with Stephen Neil Kaplan, a University of Chicago professor who studies venture capital, noting that new technologies come, and they're transformative, and that drives a lot of investment. Some of them work out, some of them don't, and hopefully, the world becomes more productive. Though his candid assessment that the thing that's hard to know is, are we in 1997 or are we in 1999, served as a sobering reminder that VC investments made in 1997 during the early internet boom generated spectacular returns, while those made in 1999 at the peak of the bubble did horribly. The competitive dynamics also shifted in ways that threatened existing business models, with AI increasingly competing against traditional software-as-a-service companies for both customers and investors. As Sagar Bhavsar, partner at Begin Capital, explained that businesses were questioning whether it made more sense to build software tools in-house, using AI coding assistants rather than subscribing to expensive cloud services, leading Sergey Grybov, general partner at Flink Capital, to declare that if your cost of building the software in time of building the software is going close to zero, the whole idea of SaaS disappears. This existential threat to the SaaS model, which had dominated enterprise software for 2 decades, meant that venture capital itself was transforming, with Bhavsar observing that few people are calling themselves B2B SaaS investors anymore, even if they did that historically, as firms pivoted toward new investment categories including computing hardware, data centers, physical infrastructure, robotics, and the emerging trend of AI roll-ups where venture-backed businesses acquire traditional services companies like IT providers, call centers, or accounting firms with the goal of dramatically improving efficiency through AI adoption, essentially bringing private equity strategies into the venture capital world. The diversity of unicorns created in 2025 reflected this broadening investment thesis, with notable successes beyond pure-play AI, including fintech companies like Kalshi reaching $2 billion for prediction markets, defense tech companies like Castellion achieving 20 Taster 2020-23 strike systems, manufacturing, space companies like Apex hitting $billion for satellite components, healthcare platforms like Function reaching $25 billion for personalized medicine, and even consumer products like Olipop's probiotic soda commanding a $2 billion valuation, though the majority remained firmly in adjacent categories covering everything from customer service automation, to Kagan at $15 billion to legal platforms, Eve at $1.1 billion, to iMusic generation, Suno at $255 billion, to video creation tools, multiple companies exceeding $1 billion, to medical documentation. Ambience at $25 billion and Abridge at $52 billion. The IPO market also showed signs of revival in 2025, with successful public offerings from fintech companies like Klarna, Circle, and Chime, providing liquidity events that allowed early-stage investors to cash out and recycle capital into new startups, while major companies including OpenAI, Anthropic, and even SpaceX were reportedly preparing for potential IPOs in 2026 that could test public market appetite for valuations and potentially unlock massive new waves of capital if successful, or trigger a broader reassessment if they disappoint. The geopolitical dimension added another layer of complexity, with the Trump administration's deregulatory approach to both technology and finance creating a more permissive environment for ambitious projects while simultaneously raising questions about safety guardrails, and the administration's push to overhaul military procurement opened opportunities for defense tech startups, even as tensions with China over supremacy intensified following DeepSeek's demonstration that American companies might not possess an insurmountable technological advantage. Looking toward 2026, the early signals suggested momentum would continue, with Elon Musk's XAI announcing a massive $20 billion Series E round that exceeded the previously discussed $15 billion target and potentially valued the company at $240 billion, while Sam Altman's brain-computer interface startup Merge Labs raised a stunning $250 million seed round, with OpenAI itself as the lead investor, demonstrating that the IE ecosystem had become so flush with capital that companies were now investing in other startups in what some observers characterized as a circular flow of money that might generate fees and headlines but questionable actual economic value. The philosophical questions underlying this historic investment wave remained unresolved. Can companies sustain their velocity of improvement, or will progress plateau as some researchers predict? Does building frontier in the post-DeepSeek era truly require tens of billions in capital? Or did the Chinese lab prove that clever engineering could substitute for unlimited budgets? Most critically, is there a viable business model that will return even a fraction of the hundreds of billions invested? Or are investors placing massive bets on a future where captures economic value in ways that nobody can currently articulate clearly? Christine Tai, founding partner and CEO of 500 Global, expected a lot more of these people coming out of the bigger names, or researchers coming out of academia wanting to start these research labs, suggesting the Unicorn Factory would continue operating at full capacity, while Janelle Tang, partner at Bessemer Venture Partners, argued that entirely new categories remain to be funded, noting, "We believe there's going to be a company that's going to build the robotic brain, if you will, that will power many different apps, many different use cases," pointing toward robotics and autonomous systems as the next frontier for massive capital deployment. As 2006 unfolds, the venture capital world watches with a mixture of excitement and anxiety to see whether 2025's $150 billion gold rush represented the beginning of a transformation as significant as the rise of personal computers, the internet, and mobile phones, or whether future historians will mark it as the peak of a speculative bubble that enriched a few insiders while destroying billions in capital and leaving behind a graveyard of overfunded companies that raised astronomical sums before discovering that solving intelligence is harder than PowerPoint presentations suggested. That even if you build transformative technology, figuring out how to charge enough money to justify a $300 billion valuation remains an unsolved problem that no amount of venture capital can answer.